how to choose the right stocks. And the process is a very lengthy one. But the way I would like to start choosing a right stock is by elimination. What it means is I have a list of criterias, and that criteria has helped me to eliminate the bad ones, and whatever is remaining, that is where I analyze the business further. So let me give you a complete list of things that I look as a negative indicator, and stocks falters on any of these parameters is an avoid right away for me. So let's begin. The first one is of course the debt parameter. So once a company has too much debt on its book, and though it may be able to repay the debt, but it means that the business requires a lot of capital to grow. And once a business is very capital intensive, I like to avoid. And so a debt is one of the first negative parameters for me to avoid a stock. So if you look at if I look at my portfolio, there is hardly any company that has debt, or even if they have a debt, they are reducing it very aggressively, and they have plans to get it to almost zero levels in the next 2 3 years time frame. So that is one of the aspects that is a red flag for me, and it's the thing that I like to avoid in any company that I'm considering for investing. The second is diversification. So if company is getting into a lot of areas, that is when I like to avoid it. So even if it is related, that's perfectly fine. But let's say a company is into adhesives, and if they get into financing, I like to avoid it, or I like to come out of that stock as soon as possible. So diversification, and if it is not something which is very related, then generally I like to avoid it. The third is too much of acquisitions. There are many companies who have done phenomenally well acquiring many small businesses, but generally I like to avoid companies who are doing too much of acquisitions, or acquisitions in the wrong areas as well, or in the diverse areas as well. Wrong would be the right, not the right word, but in a very diverse set of say categories, or diverse set of industries. That is when I like to avoid it. Even an acquisition overseas with very little books, very little cash on the books, is something I like to avoid as well. The four things that I like to avoid in the market is, once a company is too big with respect to the total addressable market. So if a company is at say, like let's say 95% or 90% of the total market, that means that it has grown its capacity. Though it's a market leader, and if the market is not growing at a very brisk pace, the company doesn't have too much of a growth ahead. So it means that it has to diversify into various segments or into other areas, and that is when I like to avoid that company, because the growth ahead, or the total addressable market ahead in that category itself, will not be a high growth company or high growth area. So that is when I like to avoid such companies. The next thing that I like to avoid in a company is, though the company is making a new lows on a weekly or a monthly basis, but still it's not a value buy. So yes, price is what you pay, but the price that you are paying right now, though it's making a 52-week low, or it's going down, but it should be a value buy at that price point. If the company is not giving me a lot of value at that price point, I generally like to avoid it. The next thing that I like to avoid in companies is PSUs. The reason I like to avoid them is because they don't work very efficiently when it comes to business aspect of it. And yes, they have given great rallies in the past 18-20 months. Stocks has quadrupled, or even 4x, 5x, 10x. They have gone from say 100 rupees to 1000 rupees. Many stocks have given that kind of a return as well. And it's good if you can understand the business, understand the working of that business. If you can find good value in that business, that's great. But generally what happens is, the PSUs are not meant to do the business in a very efficient manner. I mean, valuation is of course in their favor most of the time. And if you are only considering the valuations, or if you can analyze the business and find that they are doing it very efficiently, it might be a great investment opportunity. But I am generally not able to find that. I was not able to find that when the rally was happening, and now the valuations are also not in their favor. So generally I like to avoid PSU as a sector. However, if there is any business sense or business wise the growth is there, that is when I may even consider it. But generally speaking, PSUs are an avoid for me. The next thing that I like to avoid, or the next kind of business that I like to avoid, are cyclicals with very low PE or high trailing growth. So there has been a good growth in the past, and so the P currently looks very low, but it's a cyclical business and I don't see a future growth, or I don't see the same kind of growth ahead. So once the growth is not ahead, I like to avoid such stocks, or even such businesses, or even such sectors as a whole. Generally, I like to invest in very unique businesses where there are not many producers of the products that a company is producing. So it should be a monopoly or a duopoly, and those kind of sectors doesn't fit in a cyclical. I mean, the cyclical sectors don't fit in that kind of an investment philosophy. Because my portfolio is very small and I like to do a concentrated approach or a focused approach, so then I don't need too many stocks in my portfolio, and so I can avoid such cyclical sectors. So cyclicals are generally an avoid for me. The next thing that I like to avoid is once a company requires to dilute its stake for future growth. So debt is one of them, where company is taking a debt to funnel the growth. But there are certain companies or sectors where the I mean promoter needs to dilute its stake, get the cash to fuel the growth, and so those are also an avoid for me. The next is once I see a very high PE stock for a high growth company. So, I mean, company might be doing a 30, 40, 50% CAGR growth for the next 2 years, but that company is trading at 100, 150, 200 P multiple. And so once a P multiple is in triple digit, I generally tend to avoid, no matter how high the current growth or the next few years growth will be. Yes, I mean, it's a personal choice, and generally I like to do it that way. I generally don't like to pay too much for the growth that is there in the company for the next few years. So it's an once the P is above 100, generally I like to avoid. Yes, I have learned this over the past few years. I used to buy a high growth companies with a very high P, and it has so happened that I had to wait for 2 3 years for I mean, once the growth subsides, you have to wait for 2 3 years for the stock to re-rate. I mean, it derates, and then the valuation catches up, and then the stock rallies, and you, if you are not very patient, you generally tend to come out once you break even, and that's not very good for the returns. So generally I like to avoid any companies which are above 100 P multiple on a trailing basis. Finally, I will say invest the money in the market that you don't require for the next 2 3 years. If you are willing to wait for the next 2 3 years, market will definitely reward you. But if you are in a hurry to book profits and take the money out, market will make sure that you don't make a lot of return out of it.